How often do we find ourselves navigating through the complexities of the economy, trying to make sense of the various signals and indicators? The recent announcement from big financial institutions like Goldman Sachs proclaiming the end of the recession in the U.S. is certainly noteworthy. The GDP growth for the third quarter reported at 4.9%, later revised to 5.2%, paints a picture of a booming economy. This positive economic outlook raises questions about the Federal Reserve's stance on interest rates, especially when historical wisdom suggests that during economic booms, rates are typically raised to prevent overheating. In the midst of this economic landscape, the Federal Reserve steps in, and traditionally, during times of economic prosperity, it would raise interest rates. The logic is clear: higher rates would cool down the economy and mitigate the risk of inflation. However, recent statements from Jerome Powell, the chair of the Federal Reserve, suggest a different narrative. Powell contends that the Fed funds interest rate is already in restrictive territory at 5.5%, indicating a reluctance to push rates any higher. This unexpected stance raises eyebrows and prompts questions about the Federal Reserve's approach to monetary policy. The market's response to this unexpected stance is intriguing. Despite the booming economy, there is an 89% chance, according to the CME FedWatch tool, that the Federal Reserve will cut interest rates by the May 1 meeting. This is a significant shift from just a month ago when the odds of a rate increase were at 40%. The anticipation of multiple interest rate cuts in 2024 challenges the conventional wisdom that interest rates should rise during economic prosperity. This shift in expectations has profound implications for various sectors of the economy. The disconnect between the government's assertion of a booming economy and the Federal Reserve's indication of potential interest rate cuts adds a layer of complexity. According to Federal Reserve Governor Christopher Waller, the rationale behind potential rate cuts is the success in lowering inflation. Powell, however, is more cautious, refraining from declaring victory against inflation and leaving room for a possible reassessment if inflation were to accelerate again. The high bar set by Powell for raising interest rates implies a conservative approach, emphasizing the cautious management of inflation rather than a hasty declaration of victory. The critical role of expectations in shaping economic realities cannot be overstated. The market's anticipation of interest rate cuts has already impacted government debt yields. The 10-year yield, a key indicator, dropped from 5% to 4.2%, creating a risk-on environment. This shift encourages investment in the stock market, driving up stock prices. The interconnectedness of these elements underscores the importance of understanding the expectations and signals that influence economic dynamics. Moving away from the Federal Reserve's perspective, the government's stance on the economy is crucial. Janet Yellen, the U.S. Treasury Secretary, expresses confidence in achieving a soft landing for the economy, emphasizing the strength of the labor market and overall economic health. However, opinions diverge, with J.P. Morgan Chase CEO Jamie Dimon issuing a recession warning, citing inflationary pressures and potential interest rate hikes. Goldman Sachs offers an economic projection, anticipating a 2.1% growth in U.S. GDP for 2024, signaling a slowdown from the current 5.2%. The probability of a recession in the next 12 months is estimated at a slim 15%, according to Goldman Sachs. The projection also anticipates a 3% growth in real disposable income, suggesting that, despite the potential economic slowdown, Americans may experience continued financial improvement. Asking everyday Americans for their perspective on this economic scenario becomes crucial at this juncture. How do they perceive the state of the economy, and do they share the optimism expressed by government officials and financial institutions? Their insights could provide valuable perspectives on the ground reality, away from the macroeconomic indicators. In the realm of financial markets, the implications of the Federal Reserve signaling and potential interest rate cuts are evident. The fluctuation of bond yields, especially the 10-year yield, plays a significant role in dictating the direction of the stock market and mortgage interest rates. Understanding the dynamics of these fluctuations and their impact on investment decisions becomes essential for investors and the broader public. As we delve into the question of when the Federal Reserve might pivot and start cutting interest rates, the timeline becomes a crucial factor. May 1st is suggested as a potential date for the first interest rate cut, but skepticism arises regarding the feasibility of such an early pivot. The delicate balance between maintaining economic growth and curbing inflation requires strategic decision-making, and predicting the exact timing of a Federal Reserve pivot remains a challenging task. While there is a consensus on the need for a soft landing, concerns about a potential melt-up in asset prices in 2024 add complexity to the situation. Balancing the delicate act of easing monetary policy without turbocharging inflation is a task that Powell and the Federal Reserve face. The potential consequences of such a scenario, especially for everyday Americans and their financial well-being, are worth considering. In conclusion, the economic landscape is nuanced, shaped by a combination of government policies, financial institution perspectives, and market expectations. The Federal Reserve's unexpected stance on interest rates, the government's optimism, and financial institutions' projections create a complex tapestry that requires careful navigation. As we await further developments, it's essential to keep a watchful eye on the evolving economic dynamics and their potential impact on various facets of our daily lives. How do you perceive the current state of the U.S. economy, considering the conflicting signals from financial institutions and the Federal Reserve? Share your thoughts in the comments above. Disclaimer: this analysis is based on the information available at the time of writing and may be subject to change as new developments occur.